Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Good afternoon with another episode of Black and White Market Minute on Life Planning 101. Matt Ervin and Aaron Kennedy with you today. Talk a little bit about what's going on in the markets, Aaron. And you said it wasn't as wild as you might have thought, perhaps?
No, not as bad. Market was basically flat. Technology was down just 0.05%. Dow was up about 1. S&P was in the middle. So not a whole lot really happened. But one thing that was very interesting is, the market went from one extreme to the other almost every trading day this week.
Yeah.
So if it started really big up, it ended down.
Right.
If it started down, it ended up. So that's kind of interesting because I think people are just we're looking more like the 80s, 90s where we had more traders trying to pick off people rather than being in an ETF or mutual fund and that kind of thing. So
sure.
it's that part's kind of interesting.
Sure. Well, and you got so many quant machines out there now too, doing the the candlestick and the flying V and whatever other.
Yes.
Charting, right, for the charters, and some of that's pretty interesting. But I think how much of it's repeatable in every market circumstance, and I would say that's to be determined. But
that is to be determined.
Anyway, but you did mention something kind of interesting about interest rates, and I know that banks were trying to solicit deposits with higher CD coupons than treasuries were able to provide, and you said that, I guess those yields were really starting to tighten, the spreads on that.
So, everything you look at, you can look at it from a supply-demand standpoint, and a lot of the times it's both.
Right.
A couple weeks ago, treasuries, that was the highest yielding asset out there. Short treasuries, like 6 to 8 month treasuries. And then we started having the bank scare, and CDs started paying outwards around 5-6.
Yeah.
And treasury yields plummeted. They went from 5% down to around 4.4. Somewhere around there. Those are both very big moves. So if we look at it from a supply-demand standpoint, I think people were saying, I'm not going to the banks. Banks are going to fail. I'm going to lose my money.
Right.
So banks had to say, hey, wait a minute.
Well, I think that's important to remember, right? Because we forget, and I always even have to stop and think, yield up, price down.
Yes.
So if the yield's plummeting, that means people are overpaying, and they'll take whatever yield the treasuries will give them, meaning they'll pay a lot more, drives their return down. CDs had to say, hey, we got to raise our coupon, and so they were offering more because there was no demand for CDs.
Right, nobody wanted it, so they had to push it up. And this week they're getting even for about on the 1 year.
Right.
If we're still under a year, you're looking at 4 9s, 4 8s, CDs or treasuries. So that's good to see. That's good to see treasury yields come back up a little bit. I think it's going to be a longer fight if the market continues to fight the Fed.
Yeah, right.
And that's what we're doing right now.
Yeah.
We need to give in, let them feel all powerful, right, and then let them finish their game and move on.
Well, and I, that makes me think of the greed, right? And I was looking at one this morning. There's a 5.1 12-month CD, 6-month callable, which would put it at October.
Yeah.
And so it was like even there, like, I don't want to pay 5.1% longer than I have to. If I can stick you back with the 4% or whatever that refi rate would be. But I think everybody's kind of looking. And we had a client actually ask us, we were thinking, into the middle of the year, we might start seeing things recover. And I said, well, with some of the noise that's taking place, that's pushing back, and the Fed's going longer than I think anybody anticipated.
Yeah, I think that's my whole point. People do not believe the Fed. They do not believe that they're going to be able to slow down inflation. They don't see any problem, so they're continuing to spend. And companies' earnings haven't been all that horrible, but there's been such a big fear of missing out. Look at the NASDAQ. It's up 19% year to date.
Right.
Now that was down 32% last year, so it's still the big loser over the last year, but it's up 19. That is a total spit in the face of the Fed. You don't know what you're doing. We're going long. I mean,
yeah, it's pretty tough.
It doesn't get any more obvious than that.
No, but I think the consumer spending came out today, and that softened some. So
yes,
I think there was some of the reporting from some of the credit card companies that came out, and rates have been increasing on a lot of those, and that's where so much of this spending has been supported from is credit, not actual savings. So
yes, that's exactly right. Our credit has got to expand for our economy to grow. Mm-hmm. We have too much credit versus equity, and that's the fastest way to grow is our leverage stuff, which is our debt. Mm-hmm. So that's got to expand. Retail sales did come in softer. Mm-hmm. Unemployment's picking up. Big companies are laying people off. The market really doesn't care. I think the biggest fear, and this has been the fear, we were talking about this earlier, banks can go out and lend you money or let you borrow money at 5%. Get your CD rates. They take in money and they turn around and invest it at 3.5%, because that's what longer treasuries are, the 10-year. Mm-hmm. So how long can a bank stay solvent if they're paying out 5% and bringing in 3.5%?
It's not a winning formula.
No, they're losing money. So back that up a little bit. A bank losing earnings or not making as much money, that's no big deal. That's the way of life. Depending on whatever economic cycle it is, they're going to be making more money or making less money. But we're in this inverted yield curve. The bank has got to start bringing in their loans. Okay. If they're losing money, paying out 5%, bringing in 3.5%,
right,
they're losing equity. And all of their ratios, their safety ratios are built on that number. So they can't make as much loans. If we need loans to expand our economy, what's happening?
Right.
Bringing down our GDP. So that's the big fear. That's what people are saying, hey, by the end of the year we should be in a recession. Who knows how bad? Soft landing, hard landing, doesn't.
Yeah. It's going to be somewhere in between of soft
somewhere
and hard.
In between. It's all going to come down to how fast does the Fed revert, start making easy money again, and how long until we start growing out of this.
Yeah, we need to start paying. Let's make a deal with the Fed. Let them feel like they win, and then they can get out of the way and let us go on about our business.
Exactly. Yeah.
If only I was on the board, right? You know, how different would it be?
I think we can write that stuff in, right?
Yeah,
Nominate
sure.
you.
Yeah. Hey, let's get behind me. Yeah. No, I'm not sure how well that would work. But anyways, enough about the politics, right? But so. But we're prepared for this. This is what you've been talking about. And this week feels a little better, right? You know, the big weeks, the pullbacks, the last couple of weeks have been a little across the board, but this one feels okay. It's not fun. And I think we talked to several clients over the last couple of weeks. It's like, I want to see some green. It's like, I think we all do.
Yes.
But one thing that we're really helping people understand is we're in this for the long game. We're positioned. We're ready. You know, the week by week, it's important to watch and maintain position, but to react over one day's worth of data or even 1 month or even 1 quarter's worth of data. It's a blip in time.
Yes, that's exactly right. Just a blip in time. And, you know, we just got to be in the right position. We don't need to be sticking our head out of the turtle shell if we know something's out there.
Right.
You know, it's a little bit dangerous. We're completely safe and warm inside, and, you know, we're going to get our returns over time. And if we only get 80% of them or 85% of that return in the short run,
it's still okay.
We're okay. You know, we're in it for the long run. We want cheaper prices. That's what we're going after.
Yep. So that's good, Aaron. We're wrapped up for time today. Do you have any last minute words?
No. And everybody enjoy the springtime.
Yes.
It's time to be getting out in your yard, planting flowers, all that good stuff.
You should have your gardening already.
Yep. Turkey hunting season.
Yep. sounds great.
Don't let that sneak up on you.
Baseball, we're playing baseball with the kids. I hope everybody's enjoying their family time, and it's great. And let us worry about this stuff. That's why we're here, and y'all enjoy the stuff that's super important, and it's your family and the ones you love. So appreciate everyone, and that wraps up today's episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.